Charlie Munger held exactly 3 stocks and built a $2.6 billion fortune. Ray Dalio built the world's largest hedge fund by diversifying across hundreds of positions. Two legendary investors, completely opposite philosophies. Today we're breaking down who's right, who's wrong, and what that means for your portfolio. 2023, two conversations happening on opposite sides of the country. Los Angeles, California, Charlie Munger sits in the ballroom at the Pasadena Convention Center. He's 99 years old. Someone asks him about portfolio construction. Charlie doesn't hesitate. "We have 3 baskets for investing," he says. Yes, no, and too tough to understand. 3 baskets, that's it. His personal portfolio, 3 major positions: Berkshire Hathaway, Costco Wholesale, Daily Journal Corporation. That's how he built $2.6 billion. Same year, Westport, Connecticut. Ray Dalio's Bridgewater Associates manages $150 billion. The all-weather portfolio he designed holds hundreds of different positions. Stocks, bonds, commodities, currencies, diversified across every asset class imaginable, designed to perform in any economic environment. 2 billionaires, 2 completely different philosophies. Charlie Munger: diversification is protection against ignorance. It makes very little sense for those who know what they're doing. Ray Dalio: the holy grail of investing is to have 15 or more good, uncorrelated return streams. Who's right? Here's what's interesting: they're both right and they're both wrong, and understanding why is one of the most important lessons you can learn about investing. Because this isn't just about stocks. This is about how you think about risk, knowledge, and decision-making in every area of your life. Hey everyone, I'm Michael, and this is The Wisdom Investor, Charlie Munger. Today we're doing something different. We're not just talking about Charlie Munger. We're putting him head-to-head with another investing legend, Ray Dalio, because these two men represent the most fundamental debate in investing: concentration versus diversification, quality versus quantity, deep knowledge versus statistical hedging. And here's why this matters to you. Every investor, whether you're managing $10,000 or $10 million, has to answer this question. Do I put all my eggs in a few baskets I watch very carefully, or do I spread my eggs across many baskets to reduce risk? Charlie Munger spent his entire life arguing for concentration. Ray Dalio built the largest hedge fund in the world on diversification. They're both wildly successful, they're both systematic thinkers, and they completely disagree. So let's break this down. Let's understand exactly what each philosophy is, why each man believes what he believes, and most importantly, which approach is right for you. To understand Charlie Munger's philosophy, we need to go back to 1959, a dinner party in Omaha, Nebraska. Charlie Munger meets Warren Buffett for the first time. Warren is 29 years old, Charlie is 35. Within 5 minutes, according to Warren, they're both rolling on the floor laughing at their own jokes. They recognize something in each other immediately. But here's what most people miss. At that moment, Warren Buffett was a diversification guy. He was running an investment partnership with dozens of positions. He'd learned from Benjamin Graham, who taught him to spread risk across many cheap stocks, buy a basket of undervalued companies. Some will work, some won't, but statistically you'll win. Charlie Munger had a different idea brewing. 3 years later, in 1962, Charlie starts his own investment partnership called Wheeler, Munger & Company. And from day one, his approach is radically different from Warren's. Charlie's portfolio is concentrated. He's not buying 50 stocks, he's buying 5, maybe 10 at most. And he's not buying mediocre companies at cheap prices, he's buying exceptional businesses at fair prices. Here's the performance. From 1962 to 1975, 13 years, Wheeler, Munger & Company returned 19.8% annually. The Dow Jones during the same period, 5%. Think about that for a second. 19.8% versus 5%. That's not a small edge, that's a different universe. But here's what's even more interesting. Charlie wasn't trying to beat the market through superior stock picking. He was trying to avoid stupidity more systematically than everyone else. Let me explain what I mean. Most investors think diversification reduces risk. You own 100 stocks. If one fails, you're protected. That's conventional wisdom. Charlie disagreed. He thought diversification increased risk for people who understood what they were doing. Here's why. When you own 100 stocks, you can't possibly know all of them deeply. You're owning companies you don't understand. That's not risk reduction. That's risk you don't see. But when you own 5 stocks, you can study them obsessively. You can understand their competitive advantages, their management teams, their financial structures, their long-term durability. You know exactly what you own. Charlie called this the circle of competence. Only invest in things you deeply understand. And if you deeply understand something, you don't need 50 other things to hedge your bet. Warren Buffett was watching this closely. And over the next decade, Charlie slowly rewired how Warren thought about investing. By 1978, when Charlie officially joined Berkshire Hathaway as vice chairman, Warren had completely abandoned Graham's diversification approach. He'd become a concentrated investor. Today, Berkshire Hathaway's portfolio is astonishingly concentrated. About 75% of their equity portfolio is in just 5 companies. Apple, Bank of America, American Express, Coca-Cola, Chevron, that's it. Charlie's personal portfolio, even more extreme, 3 major positions: Berkshire Hathaway, Costco Wholesale, Daily Journal Corporation. He's 99 years old, worth $2.6 billion, and he owns 3 stocks. Now let's flip to the other side. Charlie Munger's concentration philosophy isn't reckless. It's the exact opposite. It's hyper-disciplined, systematic thinking. Here's how it works. Charlie has 3 baskets: yes, no, and too tough to understand. Most investment opportunities go straight into the no basket. He's not interested. They're outside his circle of competence, or they're mediocre businesses, or management is questionable, or the price doesn't make sense. No. A huge portion go into too tough to understand. This is critical. Charlie isn't afraid to say, I don't know. He's not trying to have an opinion on everything. AI companies, too tough to understand. Biotech, too tough to understand. Cryptocurrencies, definitely too tough to understand. Actually, on crypto, he did have an opinion. He called it rat poison, but that's a different story. The yes basket is tiny. Maybe 5 to 10 companies in Charlie's entire life made it into the yes basket. And when something makes it there, he goes all in. Here's his exact quote: investing is where you find a few great companies and then sit on your ass. Sit on your ass, that's the whole strategy. Find quality, buy it, hold it forever. Let me give you the most famous example: See's Candies, 1972. Warren Buffett and Charlie Munger are evaluating See's Candies, a small California chocolate company. It's doing about $30 million in revenue. The owner wants $25 million. By Benjamin Graham's standards, this is a terrible deal. The company's tangible assets are only about $8 million. You're paying a massive premium over book value. Graham would say, absolutely not, walk away. Charlie Munger says the opposite, buy it. Why? Because See's Candies has something invaluable: a brand, customer loyalty, pricing power. Every year they can raise prices slightly and customers keep buying. The business generates cash that can be reinvested. This isn't a cigar butt you smoke once and throw away. This is a wonderful company that will compound value for decades. They buy See's Candies for $25 million. Berkshire still owns it today. Over the past 50 years, See's Candies has generated close to $2 billion in profit for Berkshire Hathaway from a $25 million investment. That's an 80 times return, and they still own it. Now here's the key question. Could Charlie have achieved that return by owning 100 different candy companies? No, because 99 of them would have been mediocre. Concentration allowed him to identify the one exceptional business, study it deeply, understand why it would win long-term, and hold it forever. But concentration requires something most investors don't have: patience, discipline, and the intellectual honesty to admit when you don't understand something. Let me tell you what Charlie said about this. It is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid, instead of trying to be very intelligent. Not stupid, that's the bar. Avoid catastrophic mistakes. Don't invest in things you don't understand. Don't trade constantly. Don't chase momentum. Don't panic sell during downturns. Just find a few great businesses and sit on your ass. Here's the thing though, this works brilliantly if you have deep knowledge, but if you don't, concentration can destroy you. Now let's talk about Ray Dalio, because Ray Dalio is just as smart as Charlie Munger, maybe smarter in some ways, and he's built one of the most successful investment firms in history on the exact opposite philosophy. Ray Dalio founded Bridgewater Associates in 1975, the same year Charlie closed his investment partnership. Today, Bridgewater manages over $150 billion. It's the largest hedge fund in the world. And here's Dalio's core belief. The holy grail of investing is finding 15 or more good, uncorrelated return streams. Uncorrelated, that's the key word. He's not looking for the single best investment. He's looking for investments that move independently. When stocks go down, bonds go up. When inflation rises, commodities perform. When currencies shift, you're hedged. This is called the all-weather portfolio. It's designed to perform reasonably well in any economic environment. Growth, recession, inflation, deflation, doesn't matter, you're protected. And it works. Bridgewater's flagship Pure Alpha Fund has delivered consistent returns for decades, even through the 2008 financial crisis, even through COVID-19. So why does Ray Dalio believe in diversification when Charlie Munger thinks it's protection against ignorance? Because they're solving different problems. Charlie Munger is managing his own money and Berkshire's money with a 50-year time horizon. He can afford to be patient. He can afford to concentrate. He doesn't need liquidity. He's not worried about quarterly performance. Ray Dalio is managing other people's money, institutional clients, pension funds, sovereign wealth funds. They have different needs. They need liquidity. They need predictable returns. They can't afford massive volatility. Here's the difference. If Charlie Munger's concentrated portfolio drops 40% in a year because one of his 3 stocks crashes, he can wait it out. He knows the business will recover. He's not selling. If Ray Dalio's fund drops 40%, his clients pull their money. He's out of business. So Dalio builds a portfolio that statistically reduces volatility. He owns hundreds of positions across dozens of asset classes. He hedges, he balances, he engineers stability. And it's brilliant for his use case. But here's what Dalio would admit. His returns are good, but they're not Charlie Munger level. The all-weather portfolio targets 8 to 12% annually. Munger's concentrated approach delivered 19.8%. You're trading potential upside for stability. Dalio's philosophy is essentially this: I don't know which specific investments will win, so I'm going to own all of them and use statistics to smooth the ride. Munger's philosophy is the opposite. I do know which investments will win, so I'm going to own only those and ignore everything else. Who's right? It depends on what you know and what you need. Let me take you deeper into the Candies story, because this is where Charlie Munger's philosophy really crystallizes. 1972. Charlie and Warren are analyzing this opportunity. Remember, Warren's been trained by Benjamin Graham. Graham's whole approach is buying stocks trading below liquidation value. Find companies where the market price is less than what you'd get if you shut down the business and sold the assets. Candies is the exact opposite. The tangible book value is about $8 million. Inventory, equipment, real estate, that's it, but the asking price is $25 million. Warren's instinct, trained by Graham, is to walk away. You're paying 3 times book value. That's insane. Charlie says, hold on, let's think about this differently. What are we actually buying? We're buying a brand that people love. We're buying customer loyalty that's been built over decades. We're buying pricing power. Every Christmas, every Valentine's Day, people in California buy See's candies. It's a tradition, and they'll keep buying even if prices go up slightly. That's not a tangible asset on a balance sheet, but it's real and it's valuable. Here's the key insight. See's Candies generates about $4 million in pre-tax profit on $30 million in revenue. That's a 13% margin, and they only need $8 million in capital to run the business. So they're earning 50% return on invested capital, 50% year after year after year. Now, what happens if you can reinvest those profits at 50% returns? You compound exponentially. Charlie and Warren buy See's for $25 million. Over the next 50 years, See's generates close to $2 billion in cash for Berkshire Hathaway, not revenue, cash profit. And here's the thing, that cash got reinvested into other businesses. Insurance companies, utilities, more consumer brands, each earning high returns on capital. This is the compounding machine Charlie talks about. Find a business with high return on invested capital, buy it at a fair price, let it compound for decades. But here's the critical question. Could you have done this with a diversified portfolio? Let's say instead of concentrating $25 million in See's Candies, you diversified across 25 different candy companies. You'd need to invest $1 million in each. 24 of those companies are mediocre. They earn 10% returns on capital, decent but nothing special. Over 50 years, each $1 million investment might grow to $30 million. One company, See's, earns 50% returns on capital. That $1 million grows to $2 billion. If you're diversified, your total return is about $750 million. Excellent. But if you concentrated everything in See's, your return is $2 billion, almost 3 times higher. The difference? Knowledge. Charlie knew which candy company was exceptional. He studied the business. He understood the competitive moat. He recognized the pricing power. Diversification is what you do when you don't have that knowledge. But here's the dark side, and this is important. Concentration is incredibly powerful when you're right, but it's catastrophic when you're wrong. Let me tell you about a different concentrated bet, one that didn't work out. Long-term capital management, 1998. This was a hedge fund run by literal Nobel Prize winners, Myron Scholes and Robert Merton, who won the Nobel Prize in economics. Brilliant mathematicians, sophisticated models. They built a concentrated portfolio based on arbitrage strategies. They were convinced their models were correct. They leveraged massively. At one point, they had $125 billion in positions on only $4 billion in capital. That's 30-to-1 leverage. Their model said this was safe. Statistically, the probability of failure was almost zero. Then Russia defaulted on its debt in August 1998. Markets went haywire. All their correlations broke down. Everything that was supposed to move independently moved together. Long-term capital management lost $4.6 billion in 4 months. The fund collapsed. The Federal Reserve had to organize a bailout to prevent systemic financial crisis. These were some of the smartest people in the world, and concentrated positions nearly destroyed the global financial system. Here's the thing, Charlie Munger's concentration works because he invests within his circle of competence. He only buys businesses he deeply understands, consumer brands, insurance, simple, predictable business models. Long-term capital management was investing in complex derivatives, Russian bonds, mortgage-backed securities, outside their true circle of competence. They relied on mathematical models instead of fundamental understanding. The lesson isn't that concentration is bad. The lesson is that concentration without knowledge is suicide. Ray Dalio's diversification philosophy protects you from that kind of catastrophic failure. If one position blows up, it's 5% of your portfolio, not 95%. Here's another example. Enron, 2001. Enron was considered one of the most innovative companies in America. Fortune magazine named it America's most innovative company 6 years in a row. Thousands of employees had their entire retirement savings in Enron stock, concentrated. When the accounting fraud was revealed and Enron collapsed, they lost everything. If those employees had been diversified across even 20 different companies, they would have lost 5%, not 100%. So here's the question you have to ask yourself. Do you actually have deep knowledge of the businesses you're investing in, or are you concentrating based on hope, hype, or overconfidence? Charlie Munger can concentrate because he studied businesses for 80 years. He understands competitive advantages. He can distinguish durable moats from temporary trends. Most people can't, and for most people, diversification is the safer bet. But there's a middle ground. Here's what I've learned from studying both Charlie Munger and Ray Dalio. They're not actually in conflict, they're optimizing for different goals. Charlie Munger optimizes for maximum long-term compounding within his circle of competence. He's willing to accept volatility because he has knowledge, patience, and a 50-year time horizon. Ray Dalio optimizes for consistent performance across all economic environments. He's willing to accept lower returns in exchange for stability and predictability. Both approaches work, but they require different things from you. If you want to invest like Charlie Munger, you need 3 things. First, deep knowledge. You must understand the businesses you own better than almost anyone. Read their financial statements, study their competitors, understand their moats. If you can't explain why a company will still be dominant in 20 years, you don't understand it well enough to concentrate. Second, emotional discipline. Your portfolio will be volatile. If you own 3 stocks and one drops 40%, you're going to feel pain. You need the discipline to not panic sell, to think long-term, to sit on your ass. Third, patience. Compounding takes decades. You're not trying to beat the market this quarter. You're building wealth over 30, 40, 50 years. If you don't have those 3 things, diversify. There's no shame in that. Ray Dalio built a $150 billion business on diversification. It works. Here's my personal take. Most investors should start diversified, maybe own 20 to 30 positions across different sectors. Learn, study, build your circle of competence. Over time, as you develop deep knowledge in specific areas, you can concentrate. Maybe you deeply understand technology, maybe consumer brands, maybe financial services. Whatever it is, concentrate there, but diversify outside that circle. This is what Charlie calls the too tough to understand basket. You don't need an opinion on everything. You just need deep conviction in a few things. Let me give you a practical framework. Ask yourself these questions. Can I explain this company's competitive advantage in 2 sentences? If not, you don't understand it well enough. Will this company still exist and be profitable in 20 years? If you're not confident, don't concentrate here. Do I understand this industry better than 95% of people? If not, diversify. Am I comfortable with this position dropping 50% and holding it? If not, you're too concentrated. Those 4 questions will tell you whether you should concentrate or diversify. Here's the bottom line. Charlie Munger and Ray Dalio are both right. Concentration works when you have knowledge. Diversification works when you don't. The mistake is concentrating without knowledge or diversifying out of laziness. Know yourself, know what you understand, invest accordingly. So here's what I want you to take away from this. Charlie Munger and Ray Dalio represent 2 ends of a spectrum. Concentration versus diversification, both brilliant, both successful, both systematic thinkers. The question isn't which one is right. The question is which one fits your knowledge, your temperament, and your goals. If you have deep expertise, concentrate. If you're still learning, diversify, and be honest with yourself about which category you're in. Now I want to hear from you. Are you a concentrated investor or a diversified investor? How many positions do you hold? And do you deeply understand all of them? Drop a comment below and let's discuss. If you found this valuable, hit that like button and share this episode with someone who's thinking about portfolio construction. It really helps us reach more people who can benefit from Charlie and Ray's wisdom. We release new Charlie Munger episodes every day on the Wisdom Investor, so subscribe and turn on notifications so you never miss an episode. I'm Michael, this is the Wisdom Investor, and I'll see you in the next one.